614 Startups Nation, welcome to another episode of the 614 Startups Podcast. My name is Elio Harmon, your host on a very rainy day here in Columbus, Ohio, but I brought the sunshine, the California sunshine for you today. We're going to have an interesting conversation with my special guest, Michelle Murcia of Book+Street. Michelle, welcome to the show.
Thank you, Elio. Thanks for having me.
It's like having a friend on the show.
It is. It is true.
Yeah. And I got to be nice to you because you guys manage my finances too. So
that is also true.
Extra incentive, right? I can't treat you like any other guest.
No, very special guest.
All right. Well, we're going to go deep today on equity, but we can't assume that all the folks out there know who you are. So let's start with a bit of your background and a little something about Book+Street.
Great. Yeah, I'm Michelle Murcia. I'm the founder and CEO of Book+Street. We're a professional services firm that works exclusively with startups, primarily in the Midwest, to help them scale. So we do everything from strategy all the way down to bookkeeping and payroll, HR too. And we have this little niche expertise in equity-based compensation, which is what we're going to talk about today.
Yeah, it's great to have a niche, right? Because you can go really deep and solve really complex problems for your clients. So where did this desire to go into business for yourself come from? And why did you choose to go into this area?
So I've always been an entrepreneur since the age of 13. So, that's probably a common theme with everybody that you speak with. But yeah, when I was in venture capital here in Columbus, I worked with Tech Columbus, which is a predecessor for Rev1. And I looked at a lot of pitches. I saw a lot of really bad financial forecasts. And I thought if there's one thing I can do, if there's one way I could help, it was to work with these early stage entrepreneurs to help them tell their financial story. So we kind of work with entrepreneurs from every stage, particularly in the pre-seed stage when they're first getting ramped up, all the way through Series A, helping them build financial models, cash flow forecasts to understand their cash runway, and then, of course, setting them up with all of their back office accounting and HR functions.
All right. What was the worst financial forecast you've ever seen by an early stage founder? I mean, like, you don't have to call any names, but what was the one that made you just like a forehead slapper?
It's probably the culmination of many things. I think most entrepreneurs really are, they're relentlessly positive, and that's why we like to work with them. And they always think that, the solution that they're building toward is going to be the winner. And I think a lot of times the estimation of how long it takes to actually get a product to market and who's going to buy it and how much they're going to pay for it are really sort of naive assumptions initially. We've worked with some early stage entrepreneurs who start there, who really start with like, I have a problem. I personally have a problem and I know I can solve it and I know how to build it and I know who my customer is, but the majority of them don't. And a lot of times I think their expectations about how much somebody would be willing to pay for something are way off. Mm-hmm. And so to say that there's just one, there probably isn't. We all have our horror stories of things that we've seen that have been really sort of scary and eye-opening at the same time. But I would say just generally, we always work with the assumption that it's going to take you twice as long to get to market and cost twice as much.
Yeah. Now, what does it feel like to have knowledge, and then watch somebody confidently speak to you when they have no idea what they're talking about? I'm not talking about me, okay? Because I knew exactly what I was talking about when I was talking to you. What must it feel like, and what's the process that you go through to help somebody kind of come over to your side of the table? Because sometimes those assumptions have egos tied to them.
They do.
Right. So one of the things as a founder you need to be is coachable. So what is it like knowing what you know, hearing from somebody who doesn't obviously know what they're talking about, and then helping to bridge that gap for them? Because that has to be an art and a skill.
Yeah, we really do that through the financial model. So we'll sit with them and we'll ask them to put their vision goggles on and tell us what their business is going to be like 3 years from now. What is their factory? Are you building things? Are you, how are you selling? What does your team look like? We try to hit those high buckets of cost first. And typically it's the people, right? So we think about the product that we're going to build. We think about the cost of goods sold, and we think about the people that are going to be involved, the facilities that are going to be involved, those high ticket items. And we make that model very dynamic so that we have very simple inputs highlighted in green, and we sort of walk through them and say, okay, what about if our go live date shifts from July 1st of 2022 to September 1st of 2023, that's just a date you change, and it will impact the entire model. So they can see, what does it take to add 3 more headcount? If I'm, servicing 18 more customers, how many people do I need on my ops team? Those sorts of things are dynamically modeled in there. And once they start to see, hey, the number of customers I have directly impacts how many people I need on my customer support team post-sale, and they can see the impact of that on a 1-for-5 basis or whatever it is, they'll make those changes and they'll come to that realization. But it is really a coaching process the entire time we're building the model. We've had clients come to us and say, oh, can you just build me a financial model? And that's just not going to work, right?
Yeah.
They really need to understand how their business works, and we can absolutely guide them through that process.
All right. So I have a love-hate relationship with reality, which is why I have a love-hate relationship with my meetings with Arthi. Arthi is part of the team at Book+Street. Reality is important, right? We all have to live in reality because we got to go out to the market, and the market is only willing to pay for value, right? But we also need to manage our business. And so this idea of me having to deal with reality is something that working with Book+Street has been, it's awesome, right? Sitting down, going through the financial models, going through our pricing structure. But one of the things, because I'm a solo founder, I hadn't had to think about, except for equity for myself, is your niche, which is around equity compensation. So that's where we're going to spend most of our time today. When we come back after this break, hang out with us. All right. That's a little bit of a teaser. When we come back, we're going to talk about equity compensation with Michelle Murcia of Book+Street. Boom. This episode is brought to you by Rev1. Rev1's mission is to help entrepreneurs build great companies. As you navigate the waters of business entrepreneurship, you don't have to go it alone. A strategic partnership with Rev1 connects innovators to the talent, customers, space, and funding you need when you need it. Get started with Rev1 Startup Studio by visiting rev1ventures.com to learn more. Again, the website is rev1ventures.com. And just like that, we are back to the 614 Startups podcast with my special guest, Michelle Murcia of Book+Street. All right, Michelle, we're going to talk equity compensation. I hear that term all the time, but what does it mean when someone says they have equity?
That's different for different types of equity. So we'll just kind of run down the gamut. So there's founder stock, right? Mm-hmm. That's usually if you and I decide to start a company together and we're going to own it 50-50. We'd start out, we have no value created. We just have this great idea. You're going to bring something to the table. I'm going to bring something to the table, and we're going to get founder stock. And at that time, we're going to deem that it isn't really worth anything. So that's a type of equity that allows us to kind of own that at the beginning without any significant tax consequences. So that's kind of the starter. There's a lot of complexity behind that, and we can cover some of it if we have a minute. But the next type is if you were to get, say, a restricted stock award. Let's say the third person gets added to the team. Let's say someone's added in. We've already had some time pass. We've already created some value in our startup, and this third person is going to get an award. It's not a lot of value that's been created. It's kind of like our third founder, but it's late for founder stock. So typically you would issue a restricted stock award, and that award would allow them to participate as a shareholder with all the rights of being a shareholder without necessarily being one of the original founders. The next type is a stock option, and those can be both qualified and non-qualified stock options, and we can cover those in a moment, but stock options in general are the next form. And then we have restricted stock units, which are another type of award that can be issued that gives people the value of the stock over time.
Now, I know there are different kinds of stock as you've laid it out, but is there a hierarchy of stock? Like, do I really want to, if I'm not the founder, right? Are founder stock better, or you have more rights than any other category that you've outlined?
Yeah, a little bit.
Okay, so let's talk about the difference.
Let's walk it through.
Yes.
Okay. So if you're a founder, you're kind of one of the original people within the organization. A lot of people say, I want founder shares. And they may have joined a couple of years later. And you're like, okay, well, it's too late for that because we're well beyond the stage of a company where we can just give you founder stock. Typically, all of those awards are in common stock. So you have all of the rights of common stock. Same thing with a restricted stock award. What makes it a restricted stock award is that although you're being issued stock, it's typically subject to vesting and a few other restrictions. I have a lot of startup companies.
Please define vesting. I'm sorry, I got to stop
I will.
you. Okay.
I will. I'm about to go into it.
Let's do that.
So a lot of times, we'll hear from startup founders that they want to bring somebody on board. Let's say it's, a really hot developer. They kind of need a CTO, not quite there yet, but it's going to be the technical person on the team. They might bring them in and say, I want to give them stock. And it's like, okay, well, we can give them restricted stock, which means it's subject to vesting over time. And the reason why we want to do that is because this individual might not be with us for the long run. It might be that it's not a good fit. He's not cut out for the startup lifestyle. And 1.5 years is about all he can take. So if we gave him 100,000 shares, he would have only vested as to a certain portion of those. And that's all he would retain when he leaves. Mm-hmm. And that's why we always suggest that whatever equity awards we're giving to people are subject to some sort of vesting. And in this case, this restricted stock award is an actual issuance of shares. So he gets the whole 100,000 shares with all the rights with respect to voting and anything else associated with them. But if he leaves after a certain amount of time, the company can buy them back at cost.
Let's step back one more step. Can founders vest themselves? Like, you hear horror stories about two founders, everything starts off great, they have stock, but one of the founders walks away without the vesting in place. Is that common at the founder, like the first two people who join together? Okay. And would you highly recommend that right out of the gate?
For founders is a little bit difficult, right? Okay. I mean, it's you and me. We're cutting a deal. Like we're gonna give up our day jobs and we're gonna go start this startup. And for that, we're each gonna have 50%. I think it's fair, right? It shouldn't be subject to vesting.
It's like a prenup.
It is in a little way, right? Yeah.
Okay.
With respect to the people that you add in with restricted stock, those are always subject to vesting because you don't want to have someone sort of walk away with it if they're not going to stay with the team for the long run.
Yeah. So how common, because I hear it all the time, but it may not necessarily be the case, that equity compensation is common. How common is it for startups, especially startups in the Midwest?
It's getting
to hear it. So I relocated here from California 20 years ago to manage equity comp plans for Battelle's venture group. And I thought, I'll only be here for a couple of years and I'll go back to California where this is really prevalent. There weren't any companies that I was aware of that were issuing equity-based compensation here in the Midwest 20 years ago that weren't publicly traded companies with a liquid stock, meaning it could be traded on the exchange. So I've been very excited to see the growth and interest in equity-based compensation. I think a lot of it's generated from the economy in general, but mostly from the startup scene that's really grown up here. And, in order to attract people into startups in the Midwest, you're going to have to offer similar compensation as being offered in other regions where they're more prevalent. So I've been excited to see lots of startups interested in it today.
Okay. So here's the $1 million question from my perspective. We understand you kind of given us some definitions, you've given us types of equity compensation, whether it's common in the Midwest or not. My question now is, how can it be considered compensation? Because you used the term value several times, like at the beginning, not a lot of value created, a little bit later on, maybe some value, but you still need to restrict. So how can that equity, those shares, be considered compensation?
Yeah, so the most common form of compensation as it relates to equity is stock options. Mm-hmm. There are a couple of different forms of compensation, and it relates to how it's taxed and how you recognize that as an employee or a service provider in your income. But But essentially the dream is I go work at this startup, and when I start, it's worth $1 a share. And then we IPO and it's $500 a share. And I have the right through my stock option to buy that stock at $1. So a stock option is essentially a right to purchase shares at a future date at today's price. And the idea is to give that award to an individual early in the stage of a company so that they can continue to sort of build value. It aligns interests with the shareholders. As the value of the company grows, so does their ability to realize a gain from the equity position that they have. And so it is a key form of startup compensation. Most startups are light on cash. What they do have is equity. I think it's the most expensive thing that you can give to your employees. And companies should think very carefully about how to do it so as not to trip up any of the tax rules or any of the securities rules.
So you made a very important point. It's the most expensive thing that you can give away. I don't think startup founders understand that.
They don't.
Why do you say it is the most expensive thing you can give away?
Couple of reasons. I mean, if you're in it to win it, right? You're thinking right now it's not worth anything, but I've got $1 billion idea. Mm-hmm. And if you've got $1 billion idea and your company's worth $1 billion, any amount of it that you give away represents a piece of the pie.
Yeah.
And so most companies will set up an allocation of like 10 to 20% of the value of the company to compensate and award and incentivize people on their team, be it employees, consultants, key advisors, board members, to help them also realize some of that appreciation and value of the company. And, oftentimes I see startups sort of, give their co-founder a large stake, give an early employee a restricted stock award without vesting. And that individual then owns that equity position and has the right, to that appreciation without giving any work in exchange for it. So these sort of vesting provisions are important to kind of maintain the realization of that growth in the value over the time of service they give to the company.
Okay. So let's talk about doing it the right way, right? Because if it's something you're going to do and it's common, you want to do it the right way. So let's back up from the very beginning. Two founders. What's the right way to do that?
Okay, first I have to thank you for plugging our tagline, which is we help startups start off right from the start.
Yeah, and I read that ad, right? You might see that ad a little later. Uh-huh.
And that's a big part of what we do, right? We don't, and it wouldn't be the first time. So, no judgment. These are startups. Things happen very fast. But it wouldn't be the first time. We've worked with a couple of companies over the years, and I say a couple, think lots of companies over the years, where you get in and there's some sort of catalyst event, like somebody wants to buy us, or we're thinking about taking on this large equity round. We have to clean up our cap table, and you go in there and you realize they've created all these awards in letters, or maybe they haven't even documented them. And like we told Joe he was going to get 10,000 shares, and Mary gets 5, and you're like, that's not how this works. Mm-hmm. These have to be really properly documented. But let's step through, like, how do you do it right from the start? So if we start with the founder stock, you're going to want to work with an attorney. And I know a lot of startups are really, struggling with how to pay for attorney's fees. There are a bunch of, law firms around town that have fantastic startup packages. Thompson Hine has a startup package. Stansberry Weaver works with startups every day. They have very low cost retainers to kind of help startups get this initial paperwork out of the way. But founder stock, it's critical that we document these original shares, and that we understand that the basis in those shares is $0. And basis is like really a term for the IRS, meaning this is how much I paid for it when I first got it. And the reality is you paid $0 because it wasn't worth anything. It was exactly equal to the value. When you talk about a restricted stock award, which is the award we gave to the third guy who came in like 6 months later, after we already had our IP documented and we brought in a couple of $100,000. Now the company's kind of worth something, so we can't give it to them for $0. So one of the things that we need to do is we need to figure out, do we need to get a valuation of the firm? And The type of valuation that we would get would be something called a 409A valuation. There are inexpensive ways to get one. More than happy to answer any questions if anyone were to reach out on our website and ping me. I can set you off in the right direction. But the goal is to say, how much is this position worth today, so that I can go ahead and file something called an 83B election with the IRS saying, hey, I recognized I received this thing of value. It's worth this much money. I'm going to quote unquote pay my taxes on that today when it's worth 25 cents a share instead of $0.
All right, let me stop you there. This is because we're kind of in the world of value, and parallel that most people might be familiar with is maybe housing, right? So location. When you're doing that valuation calculation, do you also have to consider the startup environment within which that startup is growing? For example, you hear all the time, like valuations in Silicon Valley are they're high versus a valuation that you might get in the Midwest. So is it purely a mathematical thing, or the issue of valuation also takes into consideration where you're building your company?
So the physical location is sort of irrelevant, right? We're looking at the universe of similar startups. And just to clarify, we don't perform 409A evaluations. We assist the company with obtaining one through a service provider. And our low-cost service provider that we work with the most is Carta, which is a cap table management software company that provides the 409A valuation for free as part of their service offering. So that's typically our recommendation to go that route. The process of getting one involves creating a financial forecast for your company and a deep understanding of what the next 3 years looks like for you. And typically that's through the lens of when we go out and raise our capital round, because we don't want to say, hey, we're just going to be stagnant for the next 3 years in order to force a lower valuation of our shares, but to be very optimistic and realistic about what our expectations are. But those valuations will actually look at both the growth trajectory of your company, but a group of peer companies. And typically those are publicly traded companies that are within the same market that you're in, that are on a similar trajectory, but are a little bit more advanced and a little bit further along than you are.
Okay, so let me challenge you on that before we go to break. Company in Silicon Valley, company in Columbus, Ohio. Both are fintech companies. Both are trying to eliminate friction in payments. Mm-hmm. Both are growing revenue 10% month over month. Do they get the same valuation?
Often not.
Okay, that's what I'm saying.
It doesn't have much to do with 409A valuations, though, and I'll tell you why. The willing buyer and willing seller are the two pieces to that puzzle. Mm-hmm. So if you're in a market space that's really hot and you can attract the interest of investors, they're going to tell you how much your company is worth. And they're going to base it on similar companies within their portfolios or their sort of knowledge base and wheelhouse. I don't necessarily think Silicon Valley investors that are investing in Midwest startups are writing smaller term sheets. They're recognizing the value of those companies. It's all about kind of attracting those eyes to write that check less so than the true value of the entity. Enterprise value that you're deriving through your 409A valuation, although it should mirror what the market would pay for your company's stock, they're not quite exactly the same thing. Mm-hmm. So you have to think about that. If you're in a really hot space, we work with quite a few companies in the alternative food space. And the valuations are pretty much skyrocketing right now because everybody's trying to find a more sustainable way to manage our food supply chain. And the valuation multiples that we're seeing on companies in the Midwest are very similar to the ones that you're sort of seeing elsewhere. So
yeah, we're going to earn those valuations. This is farm country, and if anybody should be building companies that are creating sustainable food systems, it should be us. All right, you guys are getting all the gems from my special guest, Michelle Murcia of Book+Street. We'll be right back. Support for the 614 Startups podcast comes from Book+Street. Book+Street provides finance and accounting solutions for startups in the Midwest and beyond. From strategic financial support to bookkeeping and everything in between, they've got your back office covered. Let their experienced team of finance and accounting professionals help your startup get it right from the start. Learn more at bookandstreet.com and set up your free 30-minute consultation with their team today. 614 Startups Nation, we are back, and thank you guys so much for hanging out with us. We're going to continue our conversation with Michelle Murcia of Book+Street. All right, Michelle, you hear these stories of the billionaires, right? The Mark Zuckerbergs of the world, right? That founder equity, huge liquidity event, richest people in the world, your Elon Musks of the world. But what about the rest of us, right? Who maybe join a company a little bit late? What do we get in terms of equity compensation?
Well, the most common form is stock options. And there have been plenty of, stock option millionaires and probably quite a few stock option billionaires. Who knows? Any day now. But the most common form is stock options. And they can come in two forms. One is called an ISO, which is an incentive stock option. And then there's a non-qualified stock option. And the difference between them really has to do with income tax and how much tax the employee pays on the compensation that they receive from the equity award.
Yeah. Well, most people hear tax and say, give me the one that I don't have to pay any taxes on. So I know maybe that's not an option. But from a founder's perspective, when you're offering these things, what are the considerations you're making? And then from an employee perspective, how do you appropriately analyze whether or not this is a good deal or not from a tax perspective as well? And we're not giving out tax advice.
No, never. But we don't do taxes, that's for sure. But I can tell you, it's interesting. I get this question a lot. Like, why do I want to give equity to my employees? And if you're asking that question, then we have a lot more work to do than I want to do. But most companies do want to give equity to their employees as a form of consideration because they believe that it's incentivizing a certain behavior, and that behavior is to grow the value of the stock so that the employees are aligned with the shareholders. And if we're on that bus and we're thinking that everyone should have an equity position in the company, stock options is the best way to do it. Again, I think I covered previously, most startups will carve out between 10 and 20% of the capitalization of their company to award to their employees and other key stakeholders like board members and consultants. But that compensatory element, that piece that sort of gives value to the option holder is really the rise in value between what the value of the option to purchase the shares was on the day you got it and the value of the option when you exercise it. So if I give you a stock option, it's an option to purchase a share of my stock at today's price at some future date. And that future date is usually limited by the term of your employment. So that option will vest over time. It'll vest typically over a number of years, most commonly 3 to 4 years. 3 is more common these days than 4. It's usually cliff vested at most companies, meaning you have to be there for a year before any of it vests. And then most companies that I see these days are monthly vesting thereafter. So over the course of 3 years, you would earn your equity ownership percentage and have the right to purchase those shares then outright. If it's an incentive stock option, so long as you're employed with the company, you would be able to exercise it without tax. It could be subject to the alternative minimum tax, but again, consult your tax advisor. But generally speaking, you're not going to have to write a check for the exercise price plus a check for your taxes. However, when you sell those shares, and if you sell those shares before a certain required holding period, you would owe tax on ordinary income of the difference between what you paid for it and what you sold it for. So that's a little complicated.
Yes, but let's go into the simpler thing first, which is buying, exercising your option. So when does that occur? Meaning, at what point in the company is that a possibility for an employee whose options have vested?
Yeah. Sometimes companies offer the right to exercise before they're vested. I don't recommend it. It's too complicated for people typically to understand or follow, especially when it comes time for them to leave and you're going to take those shares back from them. So typically there's a catalyst. There's either they're fully vested and they're ready to make that purchase. Again, there has to be appreciation and value for it to be worth it. So the goal is that when you got your option, it was priced at a much lower amount than the time you exercised. So you've actually realized some value. Most options are going to stay alive for 10 years. So if you worked for the company for a full 10 years, you don't necessarily have to exercise them unless there's some reason to, like the company's being acquired or it's about to go public. You'd exercise your option to start your holding period as a shareholder for capital gains purposes. But for most employees, the time to exercise them is driven by termination of employment. So think startups, like you're going to work for a startup for 2-3 years, you're going to move to another one, kind of work your way up to different opportunities in your career. Almost 100% of the options are going to have some post-termination exercise period. It's usually 30 days after you leave. You have to either buy them or not.
Okay.
That's the time to write the check.
Yes, that's the time. So as long as you've met the restriction requirements, like whatever the restrictions are, you can exercise. But you're literally writing a check to exercise those options. Who is that check made out to?
The company.
Okay, so you're buying it, you're exercising your options with the company. Now, let's say they were issued at $1. And several rounds of funding later, we have this valuation. Let's say we're Series B, right? We haven't gone public. There's no liquidity event, but they're now worth $60 a share. I exercise them for $1 and I own 100 shares, right? At $60 a share. You mentioned something about selling, right? Is it possible to sell those shares at that point, or when can you take money off the table?
When do you get to realize a liquidity event for yourself? Typically, it's aligned with the company's liquidity event.
Okay.
So it's either you're going to participate in a public offering or the company's going to be acquired and you'll participate as a common shareholder at that time. That's what we see most. Most companies aren't catalyzing toward a public offering. Everybody's searching for that goal, but everyone doesn't get to go public, unfortunately.
So now, founders have 99 problems, right? The more you grow, you get closer to a liquidity event. There's also this question that has to be playing in a founder's mind of, all of these people are counting on me. This thing is worth something now. There is an offer on the table for merger, acquisition, whatever, but 2 years from now, we can go public. The difference between that is like $75 million exit or $500 million exit, let's say. Have you worked with anybody where they're coming to you with that kind of what feels to me, because I haven't experienced it, as an existential crisis, right? Because all of these early employees, there's like you're rolling the dice.
Yeah.
Like you don't know if you're going to get to 500. There's a bird in hand. Everybody here makes some money. They trusted you. How do you think about that when you talk to founders?
Well, it's interesting. We didn't talk about the other kind of stock option, which is a non-qualified stock option, which is subject to tax when you exercise it. So let's use that example that you had where it was from 10 to 60. Mm-hmm. You've got $50 a share in income that you just received that you owe tax on. Mm-hmm. If you think that the company as an employee is going to go public or be subject to a merger and you exercise those shares, you're sitting in a very advantageous position as a shareholder to kind of realize part of that exit. The reality is, though, there's no catalyst for you to exercise the option. You can still participate on a cashless basis when that transaction occurs. If you're an employee and you're not a founder, you're probably not in a position to decide or drive either one of those outcomes, right? You're there, you're working, you're contributing, you're growing value for the organization. If you're a founder, that is a very difficult time, right? It's difficult every time you raise money. But when you're thinking about, what's next for the company and you're thinking about a liquidity event, your liquidity event is also typically your employee's liquidity event. So it goes back to like doing it right from the start. Those agreements that you use to issue that equity to your stakeholders, your employees in particular, they have to have provisions in them about what happens if I get terminated. What happens to my option? Does it get acquired by the new company? Do I get to cash out all or a portion? What happens to my equity position if the founders decide to sell the company or take it public? And in each case, the answer is slightly different, but founders, that weighs on a founder's mind. I've got all of these people, these great people that helped me build this company. I'm not just already out of my yacht. I'm trying to figure out how to make sure that these individuals who created the value that I'm about to realize have a place to go, a soft landing. And so as we design those compensation plans and help companies think through how to think about it, we always think about the exit. We always think about it with the exit in mind. What's going to happen to these individuals and their options when the company is sold or it goes public. I think we mentioned that we'll be hosting an event on May 25th at Gravity, where we'll be speaking with an issuer company and an attorney that we worked with about a very similar situation. They wanted to get things documented appropriately, and we're really concerned when the transaction is complete, what's going to happen on the back end, and how do we make sure that these employees have something, warm arms to run into on the other side of this deal, because we are going to create some liquidity here, not necessarily walking away money for everybody, but definitely some liquidity and value creation in the original startup, but also then the opportunity to participate in something when the merger is complete.
Yeah. Complicated issues, which is why you need to talk to an expert, right? And Michelle and the team at Book+Street are the experts, like she said, to get a taste of some of the things that they do. I mean, I enjoy, right, the services that you guys provide. You guys are huge supporters of 614 Startups, and we appreciate you for that. So, like she said, the event is going to be on May 25th at Gravity Columbus, which is off of West Broad Street, from 4 p.m. to 6:30 p.m. You'll have information on your website. We'll share it on our social media and our website as well. So we hope to see you there. I'm going to try my best to be there because this is the kind of stuff that I enjoy. All right. If folks out there have heard what you've talked about and they want to engage with you, right, hopefully you're doing it right from the start. But no matter where you are in the cycle, Book+Street can help. So how do people get a hold of you and work with you?
Yeah, visit our website. We have a link you can click to book hours with us. We'll meet with anybody for 30 minutes and talk about, what's on their mind. You can definitely engage with us on social media as well. And if you'd like to visit us, we're in Victorian Village. Yeah. Stop by our offices.
That's right. Really nice offices, new offices. You guys continue to scale. You continue to add people because the demand, right? You are a startup too.
We are.
Right. And so, okay, so let me put you on the spot. Startup. Let me put you on the spot. Okay. What did you do about equity compensation at Book+Street?
Equity compensation, we're an LLC.
Uh-huh.
We are a consulting firm.
Gotcha.
That works with individuals. All of our individuals are dedicated staff on our team. They are full-time employees. And we have other compensation strategies that are sort of similar to that. So.
Okay. So we want equity. We want equity. No, I'm just kidding. Michelle, thank you so much for being on the show. Always a pleasure. Looking forward to the event and looking forward to working with Book+Street. Thank you so much for everything that you do.
Awesome. Thank you.
All right.
For having me.
So 614 Startups, I always end with my one takeaway. There are too many gems in this. But I think the one takeaway I will, kind of share with you is, hey, if you want something done right, sometimes it's necessary to go to an expert. Not everything is an expense. If you look at things through that lens, you may end up costing yourself in the end. Like Michelle said, equity is the most expensive thing that you can give away. So why not get it right from the start? Until next time, peace. Support for 614 Startups comes from Color Coded Labs. It's time for a better career in tech. Introducing Color Coded Labs, a 16-week boot camp that does more than just teach basic code. It's a program designed to help you actually get a career in tech. At Color Coded Labs, we've removed all the barriers to help you learn the skills you need to start a career you love in weeks, not years. All designed for people of color by people of color. Apply now at colorcodedlabs.com.